Hi, everyone, and thank you for joining. We are going to let everyone continue to log on for a couple of more minutes, and then we will go ahead and get started. Okay, let's go ahead and begin. Hello, everyone. We hope you, your family, and businesses are all safe during this pandemic and would like to thank you for joining us for our 9th Global Summit event and our 2nd virtual. This session certainly has a manufacturing focus. We're excited to have so many industry experts with us to share their thoughts on trending topics in international and manufacturing businesses and predictions for the future. The first hour of the program will feature Chad Moutray, the Chief Economist of the National Association of Manufacturers, as our keynote speaker to provide a timely update on the current economic landscape in these uncertain times. While the second hour, we will ask our panel to provide you with some insightful thoughts and strategies on covering international operations from various sectors of the supply chain. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen. You will all be on mute during the presentation. However, at the bottom of the toolbar, you will see a chat box. We encourage a free exchange of information, so feel free to type up your question and if it's directed to a specific speaker. We'd love time to answer your questions after Chad and the panel have finished their remarks. This session will also be recorded for future reference, and a link to it will be provided in the near future. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Jim Hannon, Partner and Practice Leader of Withum's Manufacturing, Distribution, and Logistics Group.
Thank you, Rachel, and good morning, everyone on this side of the pond. It is indeed a global summit as we join you from various venues today: the Netherlands, Ohio, Michigan, Washington, D.C., New Jersey, New York, and other destinations. That's not to say that we're traveling any place warm. It's about 30 degrees here in New Jersey, but on behalf of my Withum colleagues, I'd like to welcome our audience to this manufacturing flavored menu of topics today. And a special thank you to all of our clients and contacts who have supported us over the years, and especially in this past busy and tumultuous 10 months. Also, I'd like to thank a shout out to Joey Ford, our firm's contact at the National Association of Manufacturers, for his support in organizing the day's event. Chad Moutray, in his very visible role as the chief economist of the NAM, serves as their spokesperson on economic issues. We all see him quite a bit in the mainstream press, including CNBC, which I would hazard a guess a number of us have on in background in this pandemic. And Chad weighs in on everything manufacturing, so we're honored to have him here today. Prior to joining the NAM, Dr. Moutray was the chief economist and director of economic research for the U.S. Small Business Association. He's well versed in representing the interests of our many small entrepreneurial businesses in the nation, and the former dean of business at Robert Morris University. He holds a PhD in economics from Southern Illinois University at Carbondale. So a special shout out to any Salukis that are out there, Chad. and a bachelor's and master's degree in economics from Eastern Illinois University. Just from a personal perspective, if you don't read Chad's weekly Monday economic report, you're really missing out. He does a great job filtering through a ton of data and presents it in a very concise and lucid, easy format. So lucid that even us left side of the brain accountants can filter it through. So Chad, it's been a busy week on economic data, earnings, and other events. So live from our nation's capital, I'll turn it over to Dr. Chad Moutray. Thanks, Chad.
So thanks, Jim. And I guess we'll have to see if people know what a Saluki is, I guess, as part of that.
We'll pick that up with questions.
So I think you're seeing my screen, but I'm going to try to share my slides here. So there we go. Sorry about that. You'd think, after 10 months of this, we've become quite expert at this, right? Anyway, so here there are, that's my contact information. As Jim noted, if you want to get my Monday economic report and you're not a member of the NAM, you can always look at my Twitter handle there, which is @ChadMoutray. So I'm going to walk through what I'm seeing in the economy as much as I can. And when I did that, my slides just went away. So can you see them, Jim? Can you see my slides, or do you see me?
I can see your slides and you, Chad.
Oh, okay. So you're doing better than I am. All I see are my slides, right? I mean, all I see is me at this point.
Rachel, do you want to pop the presentation on?
There it is. There it is. Okay, sorry, I got it.
Okay, good, good.
I had to minimize myself, which is always a good strategy. Anyway, so I'm going to start with this particular slide here, which is just showing you the NAM Manufacturers Outlook Survey, really what it's looked like over the last, the last 23 years or so. And as you can see, manufacturing activity fell early on in this recession to the lowest level since the Great Recession, but we've seen a nice recovery since then. And in fact, I would argue that manufacturing actually ended the year kind of on a bright spot. Okay. As you look at the kind of the broader numbers here, you can see that 74% of our members were either somewhat or very positive about their company's outlook at the end of the year. That's a nice improvement from the 33.9% that we had in the May survey, but still well below what we would like to see. I mean, obviously, if you go back to the beginning part of 2019, you had 90% of our members who were positive, and really 2019 was characterized as much by the trade war and slowing global growth as anything else. And if you flash back to this point last year, there actually was a sense that things were starting to improve a little bit, right? The risk of a recession was actually lessened by Fed action and just improvements in general in the global economy until it wasn't, right? And COVID-19 hit. Which takes us then to what is the shape of the current recovery, right? So there's a large debate about what is the shape, right? Is it a V shape? Is it a K shaped? Which we can talk about a K shaped recovery in the question and answer a little bit later. I've long argued that the recovery is more of a check mark or a swoosh type of recovery. And I actually see us getting back to pre-recessionary levels of output by the second half of the year, probably the third quarter. And when we went out and asked our members when they expect to get back to pre-recessionary levels of revenue, you can see that roughly 30% of our members were already there, right? They're already back to pre-recessionary levels. Either they were already there before the fourth quarter or they got there in the fourth quarter. It's really not until you get to the second quarter of this year that you have more than 60% of our members saying that they expect to be back to where they were. And interestingly, you have, roughly 20% or so that don't expect to get back to pre-recessionary levels of revenue until at least 2022 or sometime after that. That, again, pretty much goes hand in hand with what we have been seeing and what we hear from a lot of our member companies. When we ask about the outlook for the coming months, the coming 12 months, you can see that in general, sales and production growth is relatively modest. In terms of the December survey, expecting roughly 3% or so in terms of growth over the next 12 months. A little bit more subdued activity for exports and capital spending and hiring, but each of those numbers has rebounded from where they were kind of at the worst part of the pandemic in that second quarter survey. The number one issue that we continue to see, and this has really dominated this list for the last 2 or 3 years or more, is attracting and retaining a quality workforce. It was supplanted for a couple quarters by the weaker domestic economy, but as we ended the year, this was once again the number one issue. We're hearing an awful lot about supply chain disruptions in the marketplace, especially given kind of lingering COVID-19 worries that are out there. And a large part of that also is worries about where the talent is going to come from, given some of those challenges. So this is definitely what I call the paradox, right? That even though the labor market has changed pretty dramatically since this time last year, you still have a lot of challenges in terms of finding talent, and that speaks more than anything to the structural nature of the workforce problem. So moving away from the NAM survey into the ISM survey, which is probably the more common sentiment data point that is out there, we will be getting a new ISM report. There it is. We will be getting a new ISM report next week, because next week is February already. And what you'll tend to find, well, for the most part, is much like all the other sentiment surveys that are out there. Overall sentiment fell to the lowest level since the Great Recession in April, but it has bounced back pretty strongly. And in fact, you've seen very robust levels of demand and output really for the last few months, with this measure not just over 50, but over 60 in each of those cases. Hiring has been lagged behind a little bit, but in general, you continue to see strength there. And I would expect that to continue when we get the January data again on Monday, on February the 1st. When you look at overall manufacturing production, you can see that we've now had 8 straight months of growth in terms of manufacturing output. That's true, even with September being just up 0.1, so that the talking point is still there, 8 straight months of growth. You've seen some pretty solid numbers for manufacturing production growth in October, November, and December. But with all that said, notice on the left-hand side of this chart, very sizable and historic declines last March and April. Manufacturing production fell 20% in that 2-month period, so that was a very rapid decline in a very swift fashion, as you remember. And even with 8 straight months of growth, manufacturing production is still 2.6% below where it was in February of last year. And capacity utilization is about 3.2% below where it was in February of last year. So we still have a ways to go. I do expect that by the 3rd quarter of this year, we'll be back to pre-recessionary levels of output. But again, a lot will hinge on what happens over the coming months here, especially as it relates to the vaccine and the global economy. So I'm going to walk through a number of charts, kind of going through the 19 major sectors in manufacturing. So the first one here is just looking just at the December data itself. So this is December manufacturing production, and you can see on a year-over-year basis, we've had motor vehicles, which is really an impressive 3.6% year-over-year gain there, and you'll get.
Hey, Chad.
Yes.
Chad, excuse me. The slides aren't moving up to where you're focused. They were before, but we're back to the manufacturing economic update cover page.
Okay, wonder what's going on there. Thanks for interrupting me here.
Yeah, excuse me on that, but.
So let me see here. I don't know what's going on.
Just stop sharing and reshare, Chad, really quick, and then do from current slide and see if that works.
Yeah. Stop showing application. Okay. Okay. Show. Okay, can you see that now?
Yes, and now do
Absolutely.
the current slide.
Okay.
Yeah, you have the, we don't have the full slide, but To the left margin, there's
Can you
the,
see that now?
Perfect.
we are good to go. Excellent.
Okay, sorry about that. I don't understand what was going on there, but anyway, hopefully you can see it. You can see it now.
Amen. We're good.
So now this is where I was talking about a second ago. So you have 3.6% growth year over year in motor vehicles, and that's an even more impressive figure considering what I'm going to show you in a second with regard to what happened to motor vehicles at the beginning part of this pandemic. You only really have three other sectors that have had year-over-year growth. That's computers, wood products, and food and beverage. All of the remaining 19 major sectors actually have seen some pretty sizable declines and still a ways to go to get back to where they were 12 months ago. Now, I promised I would walk through some more detail here. So the next three charts, I really wanted to get a sense of and give you a sense of just what sectors were hit the hardest during the recession. And so there's three groupings here, all ranked according to the fall that they had between February and April. So again, that was peak to trough in terms of the manufacturing decline. And you can see the steepest decline by far came in motor vehicle and parts, which was down 83.5% between February and April. If you remember, almost all auto production pretty much shut down for weeks on end last spring, and that really shows up here. And the nice thing here is it's probably the only one of these that looks like an almost perfect V. So that by December, we were only down 1.9% in that sector. And the rest of the sectors on this chart, really, these are the sectors that fell anywhere from 25% or more over that 2-month period. And there's only one of them actually that is positive relative to where it was in February, and that's aerospace and miscellaneous transportation equipment. That's predominantly because of, and I'm not going to get into it too much, but obviously some unique challenges there as it relates to Boeing and to aerospace. Some nice encouraging news, I guess, for that sector at year's end. All of the rest of them still have a ways to go to get back to pre-pandemic levels, although obviously some progress has been had there. The second grouping, these are the next 7 sectors. These are sectors that fell anywhere from 15 roughly to 25% between February and April. And as you see here, many of them are getting close to getting back to pre-pandemic levels, but none of them has actually gotten there yet. And you can hopefully see some sectors in there that interest you. And then the last grouping here are the 5 sectors that actually fared the best during that period. Now notice that all of them had declines, as you would expect. Paper fared the best during that time frame. It only fell 3.7% in terms of production. My joke there is that was the toilet paper phenomenon, but I'm not sure that's how true that is, but that was perhaps part of it. And the other sectors up here, I think there's a few storylines to be told, right? The first one is, and the most obvious, at least to me, is the computer and electronic products trend line. So this, even pre-pandemic, just look at the sharp increases in production seen in that sector as obviously computer and electronics continue to dominate the conversation with so many companies and individuals talking about technology and the importance of technology. And obviously we're all virtual today, and so that helps kind of accentuate that trend line. The other one obviously is paper. Even though paper fared the best over the pandemic, since the pandemic, you actually see that trend line actually has been on the decline over much of this time frame from 2015 on. And then I guess the other one to talk about is food and beverage and tobacco. It's predominantly food and beverage. It's the only one of these 5 that actually is positive on a post-pandemic here. So again, a lot of detail there, but hopefully you get a sense here. And the reason why I go through this is to give you a sense that manufacturing is not monolithic, right? There's a lot of storylines there, kind of behind that 20% decline between February and April. There's some variance there, which is pretty significant. So if you're looking for some signs of encouragement, which I'm sure all of you are, this next one should be that, right? So this is showing you core capital goods spending in the economy. So this is a nice proxy for capital spending. And you can see here that, yes, you see the pandemic effects here, but the nice encouraging thing from my perspective is that the core capital goods orders as well as shipments not only have improved to above pre-pandemic levels, but they actually hit all-time highs in some of the more recent data. And this, at least to me, is suggesting that manufacturers and the economy in general is starting to reinvest in their businesses. And that is something that we obviously are looking at. Certainly it speaks, I think, to a cautiously optimistic outlook for this year. I think the other number that I would kind of lump in with this one is the job openings numbers that we'll talk about in a second. Another sign, at least to me, that the companies are starting to think about their future and reinvesting along those lines. When you look at the global economy, and we'll be updating this chart next week as well, because in February we'll get the January data. But you can see here also an encouraging sense that the global economy, while it is still suffering from some weaknesses, which we'll talk about, has obviously improved as well. There's a lot more blue on this chart than there was just even a few months ago. And in fact, 8 of the top 10 markets that we sell into had expanding manufacturing sectors in the month of December. And you really only had 2 sectors that weren't, right? One of them is Mexico, which continues to have a number of challenges. It's really kind of not really improved much really over the last few months. Japan up here is black, which means it was neutral, or exactly 50 in December relative to November. But in November, it was contracting, and so actually the Japanese economy is also improving a little bit, and I would expect it to be expanding when we get the January data next week. Overall, the global manufacturing PMI number was the best in 2 years. That was true of the US number as well. Now, with that said, there was definitely some caveats to note here. Number one is none of these markets are at pre-pandemic levels. So much like the US, they have a ways to go to get back to where they were in February, or at least before the pandemic. The country that has probably been the strongest there has been China. China has been a bit of a bright spot, but even it is not back to pre-pandemic levels. The other comment to make here has to do with Brexit, right? So that UK number, 57.5, part of why that number was so strong was a lot of worry about the Brexit activity that could have happened at the end of December. And so you had a lot of people, buying up inventory, trying to get ahead of perhaps some calamity that might happen if there had been a harder Brexit at the end of December. There was a last minute deal though, and so obviously that was something that we can move forward from. The UK number for January is a little bit lower than this, at least according to preliminary data, which you would expect. The other kind of comment to make here is that, especially in Europe, you're seeing a lot of weakness in the service sector, very strict restrictions because of COVID-19 and the continued spread there. You see that in France, you see that in the UK and other places. And so the service sector PMI numbers actually have slipped back into contraction in December and January, and that's weighing down a little bit on the manufacturing sector, although as you can see here, at least for December, those numbers were still positive. So hopefully that's a sign that once we can get past the vaccine and getting back to a sense of normalcy, we'll continue to see some continued progress on the global side. I added this particular chart because there is a lot of talk about what's happening with the dollar. The dollar has fallen roughly 10% since the end of April of last year. Now, to be fair, there was a run-up in the dollar in the couple months before that, as the pandemic really kind of sent the dollar skyrocketing in that kind of rush to safety. But the larger storyline, and the one that you continue to hear about in the press, is the fact that the dollar has depreciated so strongly in recent months. You've also seen, Treasury bonds pick up a little bit, kind of getting closer to the 10-year Treasury getting over 1%, and so that has started to have a little bit of an effect here. But in general, a weaker dollar should help exports, although it has the counterbalancing effect of making our imports a little bit more expensive, particularly as it relates to raw materials. Moving to the unemployment rate, so the labor market obviously is going through a significant amount of pain, and we can talk about that. But there's also progress to be said here, right? So we peaked out at 14.7% unemployment in April. It's down. That has fallen to 6.7. So that's a nice encouraging sign that it's just declined so quickly. Although the reality is that that's still about double where it was this time last year. Last time in January and February of last year, it was 3.5, which was the lowest in 50 years. And as you saw in the initial claims data that came out this morning, we still have more than 18 million Americans collecting some form of unemployment insurance. And it's also fair to say that there's a lot of folks who are discouraged, who might be working part-time, who would like to be full-time, et cetera. And so the labor market in general continues to experience a lot of pain, especially for women and for minorities. I think you're seeing a lot more suffering in this recession than you've seen in other recessions amongst some very disadvantaged groups. And so that's something we're going to continue to watch, even with some pretty significant progress there. In terms of the manufacturing employment numbers, we have, much like the production data that I showed you earlier, we've had 8 straight months of growth in terms of manufacturing employment. In fact, manufacturing, as I said early on in this presentation, actually ended the year as a bright spot. Notice we added 38,000 workers in the month of December. If you flash back and remember what the rest of the economy looked like, non-farm payrolls actually were negative in December for the first time since April, largely because of weakness in the service sector, especially in travel and hospitality and restaurants and bars and that kind of stuff, as well as state and local governments. Each of those continues to really be challenged by COVID-19 and especially with some additional restrictions placed in many markets. And so manufacturing actually was a bit of an outlier there in that we had a positive month. Even with 8 straight months of growth, though, notice that we lost 1.3 million workers in the month of April last year alone. And so we actually ended the year down 557,000 workers in the manufacturing sector. That was the first negative reading since 2006, but obviously the sharpest negative reading since 2009, so since the Great Recession. We overall are down 543,000 workers since February, so since the pandemic began. So we had 12.85 million workers in February, 12.31 million workers in December. I expect to continue seeing manufacturing growth over the coming months, although this is going to be a steeper climb than the one we had for production that I showed you earlier. When you look, much like I did for production, when you look at the sectors that where their employment levels are in December relative to February, you can see that all 19 major sectors actually still have negative employment relative to what they had in February. Some sectors obviously have fared better. You can see at the bottom of the list here, plastics and computers, and et cetera. At the top of the list, though, you see some very sizable declines for transportation equipment, fabricated metals, machinery, et cetera. The transportation equipment number is predominantly coming from motor vehicles, but it also is aerospace, is a large chunk of that as well. And with that said, the paradox that I mentioned earlier, right? So even though we have a pretty dramatically different labor market than we had before the pandemic, job openings actually have remained relatively strong. And in fact, in October, we had an all-time high level of job openings in the manufacturing sector. That pulled back a little bit in November, but that still was 498,000 job openings in manufacturing, so relatively strong, clearly rebounding from where we were over the summer months. And to me, as I kind of hinted about when I was talking about capital spending, it's a sign that manufacturers are feeling comfortable enough to go out there and put job postings back out in the marketplace. Now, notice that there's a bit of a time lag here. We don't have the December data yet, even though we have December jobs figures. And we'll be getting in a couple of weeks the December JOLTS data, the job openings and labor turnover survey data. But until then, we have to look at proxy data, and that proxy data has actually suggested that December data is slowing down a bit. I thought I had a chart there, but I didn't, so that's why I moved to retail sales. But you've certainly seen other data which have slowed a little bit, and so I would expect, even though job openings will remain relatively strong, that it will slow a little bit. Okay, so I'm going to talk a little bit about retail sales, housing, and then I'll get to the outlook, and then we'll get to Q&A. So that's just to give you a timeline of where I plan on going from this point out. So on retail sales, as you saw in the GDP data that came out this morning, we ended the year on a fairly disappointing note on the retail side. But before I get there, let's talk about the left-hand side of this chart, right? So on the left-hand side, you see very sizable declines in March and April. That 14.7% decline in April was the largest decline ever in the history of the series. But it was followed by the largest increase in the history of the series with 18.3, and you saw really solid gains really May through September, actually. And really what's going on behind the scenes here is what we economists call transfer payments, right? So if you remember back last April and May, many Americans got stimulus checks in the mail, as well as we had, at least until the end of July, we had some additional unemployment insurance compensation. So you had an additional $600 a week. All of that additional government money or government stimulus helped prop up personal income over that time frame, really helped the overall retail market recover much faster than the rest of the economy, such that by July, we actually had seen retail sales bounce back to pre-pandemic levels already, right? So that really helped kind of stimulate economic activity in the second and third quarters as it relates to consumer spending. But by the time we got to the fall, that started waning off a little bit. And you also had lingering worries about COVID-19, such that by the time we got to November and December, you actually had declining retail sales. And again, additional restrictions were put in place. And much of the weakness that we saw, the disappointing data on the retail side, really helped provide the impetus for the additional $600 stimulus checks that went out at the end of December. A large part of why the Biden administration is wanting to do some additional stimulus in January and February is to help kind of prop up the retail spending numbers. And so clearly we've seen softer data than we would like on the retail side. Yeah, at the same time, I think it's fair to say that it's not all negative, right? We still are seeing on a year-over-year basis, retail sales into the year actually up relatively modestly relative to where it was the year before, although clearly softening and a bit worrisome relative to where we would like to be. So retail sales can be a bright spot, but it has been a bit more of a disappointment more recently. And again, when we get to the GDP data, I'll show you that it was a bit disappointing in the fourth quarter data that came out this morning. And you see also on the auto and light truck vehicle sales, that sharp, almost V-shaped activity. This is very reminiscent of what I showed you in the production data earlier. Auto sales actually fell below 9 million annualized units in April. They bounced back pretty strongly to roughly 16 or so million by November, and then have pulled back a little bit in December, again, as you've seen some broader weakness in the retail side. Moving forward, I would expect to see more than 16 million vehicles sold this year. It could be as much as 16.5 or 16.8, although we continue to hear some challenges on the vehicle side with supplier constraints, et cetera, especially with chips, is what I've heard from some of our member companies. If you're looking for bright spots, housing continues to be one of the brighter spots out there, right? So you see here what's happened to overall housing starts over the last year. This chart is impressive, but not as impressive as this one, which is showing you single-family housing starts and permits really over the last more than decade or so. And you just look at that rapid run-up in housing starts and permits at the end of the year, really hitting the highest level since 2006. I'm going to have to change this chart to actually include 2006 on it, just to get a sense of just how big that is. So this is basically the highest level of activity since before the Great Recession and the huge housing run-up that we had during that time frame. And this has largely been buoyed by mortgage rates that have been near historic lows. They have started to edge a little higher in the last couple of weeks, but still historically low. The one challenge to note here is that inventories of new homes for sale continue to be pretty low. And because of the tremendous demand in housing, we've also seen some supply constraints in that sector as well, pushing up lumber prices and making a real shortage of labor be a big issue, et cetera. And so you still see some challenges on the housing side, although as I noted, it's really one of the brighter spots in the economy now. So that's the residential side. On the non-residential side, it's a little bit more not as impressive. So you've seen a little bit more lackluster numbers for manufacturing construction. Certainly you see the trade war and the pandemic effects in these data, although they have stabilized as you got towards the end of the year, and I would hope to see some slightly better data in 2021. That probably will put it a little bit of a differentiator between manufacturing and overall non-residential construction. Overall non-residential construction probably will be lower in 2021, especially when you look at office space and commercial building space, and people kind of reassessing post-pandemic how much space they need. The forecast for non-residential private construction is actually expected to be down 2.5% in 2021. And I'm gonna, before I get to the outlook, end with this chart, and just out of fairness, I'll say that we're gonna get a new figure for the PCE deflator tomorrow when we get new personal income and spending data from the Bureau of Economic Analysis. But I'm gonna put this chart up here to say that we've seen a huge run up, and when you talk to manufacturers in the cost of raw materials. Raw material costs have really skyrocketed of late, especially for steel, but you hear it for other commodities as well. Lumber, as I noted a second ago, for housing. And so you're seeing that kind of play out, especially in the producer price index data, as well as a lot of the sentiment survey data. This particular measure is the personal consumption expenditures deflator, or personal spending deflator, that BEA puts out. It's the preferred measure for the Federal Reserve. And you can see here, there has been a run up overall in inflation in this measure, but it's remained well below the Fed's goal of 2%. And so if you heard Jay Powell speak yesterday, you more than likely heard him say that overall pricing pressures remain largely under control, at least for now. And in fact, they're much more worried about a slowness in the economy than about inflation. That could change, but at least for right now, that's the stance that they're taking. So the next few charts are actually fresh from this morning. So we did get new GDP data this morning for the fourth quarter. I like to start with this chart because it shows you that larger trend line that was pretty pervasive leading up to the pandemic. And then you see the huge dent that COVID-19 took for real GDP growth, and then the bounce back that we've seen since then. As I said earlier, I do expect us to get back to pre-pandemic levels of GDP by the third or fourth quarter of this year, although it'll take a long time for us to get back to that trend line that we were on pretty steadily pre-pandemic. And so encouraging news that we're going to continue to make progress, but again, the damage is done in terms of getting us off that trend line. So this morning we got data on GDP growth. So you can see here, we increased GDP. The U.S. economy grew by 4% in the fourth quarter. That actually is a little bit of a disappointment. The consensus was more than that. In fact, if you heard me speak earlier in the week, I would have said a 5 or 5.5%. So that was a bit of a slower number. Largely, it was weaker because of consumer spending, and I'll show you that in a second. Especially as we got towards November and December and the weaknesses that were there. You see very large swings in activity this year, right? So that negative 31.4 was the lowest ever, right, in the history of these quarterly data, which date back to 1947, followed by the largest increase ever, right, with a 33.4. Overall, we were down 3.5% in terms of U.S. economic growth in 2020. That was the weakest number of growth or the largest decline we've seen in GDP since 1946. So you're going to see that headline quite a bit in the press. Moving forward, though, I see us growing 4.5 to 5. Excuse me, 4.8 to 5% this year. I think a lot will hinge as you move forward on what happens with the vaccine, what happens in terms of additional stimulative measures that the Biden administration might put out early on. That could be obviously some additional stimulus checks. Later in the year, it could be some additional infrastructure dollars that might be discussed. And so we'll see where these numbers kind of play out depending on where the federal government spending goes. But at least for now, it's a nice sign that growth should accelerate. And there's a lot of both upward and downward potential here. The downward potential obviously has to do with the vaccine and its prevalence and how quickly we get back to normal. the upward potential is that things obviously could improve in the second half of this year. When you're looking at the fourth quarter data themselves, I mentioned earlier the big weakness was coming on the consumer side, and that was essentially flat, right? So I think that's the real challenge here, is the consumer spending, which is 70% of GDP, was essentially flat for the quarter. And you saw net exports be the real drag on GDP in the fourth quarter figures, with really imports recovering a little faster than exports. And the real positives in the economy coming from service sector spending, business spending, and residential, as I kind of figured earlier. And then the last chart that I'll show you is on my prediction for manufacturing production. We ended the year basically down 6.5% in terms of manufacturing production, and I expect, coincidentally, for us to be up 6.5% this year. So with that, there's my contact information. Again, a reminder, if you don't follow me on Twitter, you can at that handle there. And I'm going to stop sharing my slides so that I can see people when they ask me questions.
Okay, well, a couple of them are coming in, Chad. Let me just rattle them off. What do you foresee as priorities in trade policy for the Biden administration? And let's see, where do trade and economic nominees fall on the spectrum? Are they hawks? Are they doves? Maybe you can comment on that.
Well, I think the important thing to note as it relates to trade is just the last few years were a lot of uncertainty there, right? I remember many times when I was asked to comment on a tweet, or when President Trump threatened to close down the Mexican border, of that kind of stuff. And so I think the one thing that we're definitely looking to in a Biden administration is hopefully some increased certainty, right? Hopefully there will be some additional trade agreements that will come up as well. Certainly there's going to need to be a trade agreement with the UK, for instance. So that certainly is going to be something that is going to be important. With that said, though, I think it's still an open question what the rest of trade policy looks like, right? So I think at least the Commerce Department nominee, Secretary Raimondo, has said that they expect to continue to be tough on China, right? So there's going to be potentially a change in tone, but I think still it's expected that trade policy, at least as it relates to China and some other markets, will still continue to be relatively aggressive or protectionist in some ways to try to help protect U.S. interests.
Thank you. Next one, Chad, is given the relationship with China in the past few years, trade wars, tariffs, pandemics, issues on intellectual property, how does NAM see the likely path forward with Beijing?
Well, I do think, as I hinted there a second ago, I mean, I think, the Biden administration, at least so far, has hinted that they're going to continue to be tough with China, right? There certainly is going to be potentially a difference in tone, and I suspect a Democratic administration will focus a lot more on human rights, as they almost always have, than a Republican administration did or would. But I think that the tendency there is going to be a continued aggressiveness as it relates to U.S. interests. China continues to have a very large trade deficit, for instance, with the U.S. And so I think that there's going to be a lot of forces within the Biden administration which are going to continue to want to see what they can do to bring that down. You've already seen some very tough elements of trade policy here in the last few days, with some executive action that the President Biden has made. And so I would expect actually to see some continued toughness there as it relates to China, but also some other markets as well.
Okay, a question from, I guess, one of the motorheads out there. Comment on the advent of electric vehicles on our economy, or are the majority of parts and components sourced from foreign vendors and suppliers?
So the question was on electric vehicles?
Yes.
Yeah. I mean, I think certainly that is the trend line, right? I think companies are General Motors and a lot of the other automakers, priority number one is getting more electric vehicles out there, right, in the marketplace. There's a lot of good reasons for doing that. I think there's also are clearly incentives from governments, especially local governments, that are going to disadvantage certainly encourage more electric vehicle production over the coming decade. The challenge, as you noted, though, and I think this was in the Wall Street Journal just a couple of days ago, is that many of those resources used in electric vehicles are not sourced from the U.S., right? That includes batteries, but it includes a lot of other conflict minerals as well that are not produced here. And so I think there just needs to be a huge incentive for us to make more of those commodities as well as manufactured goods here as much as we can, not just from a sheer reason of doing it to increase U.S. manufacturing production, but also perhaps also from a national security standpoint.
Okay, thank you. President Biden recently signed an executive order to source government buying from domestic manufacturers. Is there substance to this edict, given the long-term basis of contracts that have already been negotiated and signed?
Repeat the first part of that question again.
President Biden recently signed an executive order to source government buying from domestic manufacturers.
So yeah, so we, obviously, we have long wanted to make more in the U.S. I think, not surprisingly, the National Association of Manufacturers has encouraged more onshoring, trying to encourage more investment to be in the U.S. We put out some proposals last May, recognizing that so many manufacturers were already talking about reevaluating their supply chain. A number of policies that Washington could adopt that could help encourage even more of that, right? Everything from infrastructure investment to workforce development to tax policy and regulatory policy, et cetera. So I would encourage folks to go look for that on the NAM's website. As it relates to the Buy America plan, I think it's safe to say that we have manufacturers, a wide variety of manufacturers in that space, and so we have been relatively, we haven't really taken a position as much on that. Okay,
thank you. Next is, and you referred to Chairman Powell's comments earlier, but is your thoughts on Powell's comments of yesterday on, quote, a long way from a full recovery?
Yeah.
At face value, it sounds like they'll keep an easy money policy in place until we recover. Thoughts?
Yeah, so I mean, I kind of noted earlier that the Fed is clearly more worried about economic growth than they are about inflation, at least for right now. Clearly, overall inflationary pressures, core inflationary pressures are well below 2%. They have been that way for a couple of years, and we're still well below pre-pandemic levels of output. We're still well below that trend line that I showed you earlier. So the Fed has early on engaged in extraordinary actions to kind of help stimulate the economy. They're still going out and purchasing billions of dollars of government securities every month, right? And so that quantitative easing is still happening, and Chairman Powell yesterday said that's going to continue for the foreseeable future. And obviously interest rates are near zero and have been near zero since the beginning part of this pandemic. The Fed does not intend, at least according to their public statements, does not intend to raise rates this year. And many of the market participants on the Federal Open Market Committee don't see them raising rates in 2022 either, right? Although I think that that's more of a mixed picture. My own personal view is by the second half of this year, you're going to start seeing growth in the US and globally pick up pretty substantially, particularly once we start getting back to a new normal, whatever that looks like. And you might start seeing by the second half of this year, probably towards the end of this year, the quantitative easing start to pull back, right? And a reevaluation of rates as we move into 2022, such that they actually might start raising rates at some point next year. So,
okay. Chad, next one is, with the Make in America executive order taking effect and several other countries implementing, mandating similar nationalist policies, encouraging their domestic manufacturing, where do you see the future of international manufacturing collaboration?
I think this has kind of also been the open question kind of as we move into the coming years, is what to make of globalization. mean, we've had this huge stride towards increased globalization over the last, really since Bretton Woods, right? And everyone has really embraced free and fair trade as much as we can. We've seen a bit of a pullback of that really over the last few years. It didn't begin with Trump, but it certainly was accelerated by it. And I think the open question here as we move into the next few years is how much people will go back and embrace free and fair trade again, right? We certainly are going back and rejoining those international institutions like the World Trade Organization, et cetera. We're certainly going to be embracing some new trade agreements with the UK and others. But I think it's notable that, when we walked away from the Trans-Pacific Partnership 4 years ago, right, which would have essentially been a counterbalance to China, right? When we walked away from that, the rest of the parties in the TPP reached out to China and they renegotiated an agreement without us, right? And so we are now on the outside looking in on that agreement, which could have been a nice, as I said, counterbalance to China, would have been a win-win for us. And so now we've got to find ways, at least in my view, for us to continue to find opportunities and to renegotiate some additional agreements that help us make that case globally.
Okay, that's your crystal ball. We'll see, right? Okay, the next one is, Chad, is we tend to focus on Europe and Asia. What is the outlook for manufacturing, including conflict mineral extraction in Africa? Other countries, China, have entered Africa forcefully. Will the U.S. be impacted by other countries who buy large amounts of raw materials from Africa sources?
Well, when you're thinking of large investments in Africa, you're thinking obviously of China, and China has been has been growing so rapidly, and they've needed resources so desperately that they've needed to go out and invest in Africa, but also other pockets of the world where they can get the resources that they need. There's a lot of potential in Africa. There has been for a long time. I think you're going to continue to see investments not just by China, but also by the U.S. there. The challenge for Africa has long been, depending on what market you're talking about, some political uncertainty there. But I think the potential for growth is significant, and I think you're going to continue to see U.S. investment there, much like we've seen over the last few years, rivaling what we've seen in China.
Okay. Chad, the next one is, you see a lot of data in surveys. Besides the GDP, what one or two data points should we place the most weight on in evaluating the strength of the economy? And are there any sleeper type data points that you like that don't get a lot of press?
Well, obviously, 70% of the economy is consumer spending. And so the consumer matters, right? And so whether you're looking at personal income and spending, which we'll get tomorrow, or consumer confidence data, I think it's important to look at what's happening with the consumer. What are they thinking, right? They get spooked, right? As you've seen, lots of uncertainty over the last few weeks, and consumer confidence falls, and people tend to hold on to their dollars. And so I think you got to watch the consumer, see what they're doing. It's clear that some pockets of consumers are really hurting right now. So there was a study that came out a couple days ago that households making less than $75,000, those people, when they got the stimulus checks, the $600 stimulus checks, they predominantly spent it because they needed it, right? Households over $75,000 tended to save those dollars. So you have seen the savings rate pick up pretty substantially. You've seen people pay down their credit cards pretty substantially, but I think much of that savings has been amongst higher incomes. So I think watch the consumer, watch what happens with them. I think that's a large part of the story. Obviously, as it relates to manufacturing, you want to pay attention to what's happening either with sentiment data, the ISM data, or manufacturing production itself. And not just in the US, but you want to look globally as well. I long feel that as we continue to see China continue to grow and flourish, and they've bounced back pretty strongly after COVID-19, a strong China means a strong rest of Asia, and you also tend to see rising pockets throughout the rest of the world as a result of that. So look for manufacturing activity not in the US, but also what's happening in China, and I think that's a nice harbinger of what's going to happen in the global economy.
Great, thank you. Where would the Fed like to see the unemployment rate settle at?
Well, I think the Fed would like to see the unemployment rate somewhere back to where it was, probably in the 4 to 4.5% range. And I think by 2022, we could definitely get back to that number, right? And so I think that's kind of the figure that they're looking at to kind of get back to a healthy growth is somewhere around 4.5% unemployment.
Okay, thank you. I think the final one is, and you actually talked about this in one of your slides, but the cost for raw materials and construction and manufacturing process have increased quite a bit in my shop.
Yeah.
Any inflation concerns to monitor going forward?
So we definitely have, and as I said, I continue here, especially in metals. The steel prices have gone up pretty sharply. But again, that's not limited to that. I think a lot of other commodity prices also have gone up. I think some of those are transitory. I think that some of it is uniqueness to the fact that we've had some pretty significant supply chain constraints. Once we can start normalizing those supply chain constraints, I think those prices hopefully will come back down to earth a little bit. And so that I think is where the Fed's perspective is. With that said, I also think that we'll start seeing, as the global economy improves, you'll start seeing commodity prices in general start rising. I expect, for instance, just to show you oil as an example, currently West Texas Intermediate selling around $52 a barrel. I wouldn't be shocked to see that number get to $60 a barrel by the end of the year, as you see continued growth in the global economy, and that increased demand will push those prices higher.
Okay, just checking the chat box here. I think we're all set, Chad. Thank you so much for for supporting the industry, all you do in terms of filtering through a number of economic data, some of which make, I guess make your hair turn gray. I can attest to that individually, but certainly having your focus and your colleagues at NAM representing all the interests of our stakeholders, it's greatly appreciated. So thanks for all you do. And as I said, you're missing out if you're not on Chad's list for Monday morning economic report. Must be a busy Sunday night for you, Chad.
The dirty little secret is I write it on Friday.
Oh, okay. We won't tell anybody.
And Chad,
Okay.
I will admit I looked it up. A Saluki is the oldest of all domesticated dogs. It was the dog carved on the Egyptian tombs. And
Right.
apparently Southern Illinois was previously known as Little Egypt. So there's your Saluki answer. I learned something today.
At one point in Illinois, Cairo used to be the biggest town in Illinois, Southern Illinois, kind of on the border with Kentucky. They say Cairo, everyone else would say Cairo, but because of that, that's the Egyptian reference there.
Very interesting.
And being from the New York area, Walt Clyde Frazier was an outstanding guard for the New York Knicks in their heyday. So, so hail Salukis.
Thank you.
Terrific. Thank
Chad,
you.
thanks
Thank
so
you
much.
so much.
Yeah, I don't see any more questions. Kimberly, I'll turn it over to you for the panel
Thank
section.
you. Thank you.
Thank you, Chad.
Thank you, Chad. Lots of notes taken during that session. I really enjoyed it. We're turning to our panel. We have 4 experts in international manufacturing, distribution, and logistics here to share their insights with us. As you can see, we have Jason Maria Rathenham. He's a senior consultant at HLB Vandal. They're a member firm of HLB, who we're affiliated with. We have Vinita Mehra, who's the director and leader of global business for Kegler, Brown, Hill, and Ritter, and Sushita Sonalika, who's the director and head of North America for the Confederation of Indian Industry, and Jason Thomas, who is now a partner at withumsmith+brown, but previously was a CFO of the US subsidiary of an automaker. So we are going to start with Vinita, and she's going to share her thoughts with us. As I said, she is the global practice leader. She received both her BLS and her LLM or her law degree from Mumbai University Government Law College. She counsels corporate clients regarding a broad range of complex national and international corporate transactions and intellectual property issues. And I'll turn it over to Vinita.
I always do that. I don't unmute myself. But thank you so much, Kimberly, for that introduction. And thank you for the opportunity to present. If we could get to the next slide, please. When I prepared this presentation, and I think there were a lot of questions that Chad was getting, we got this presentation to Withum yesterday, and then just yesterday, as a part of the Build Back Better initiative, President Biden issued an executive order, which kind of tightened the Buy America requirements. It's not that we did not have executive orders in the past about Buy America, but this was a step forward in terms of their policies that they are trying to put in place with respect to making sure that there is increased manufacturing in the US, which then leads to more job creation. And in some way, this executive order is a bit different from what we've seen with in prior administration. And again, like I said, this order came out yesterday. It actually came out on late Tuesday, but most of the content that we are getting fed was yesterday. So we still need to get into the details and see what, because the devils are always in the detail. But if I have to summarize, there are three key takeaways from this executive order. One is there's going to be a tighter requirement for domestic content, which is under consideration as a part of this order. There was always a consideration under the Buy America Act for domestic content, but they are going to make that even more stringent with respect to products that are bought by the US government. A thing that's new under this order is the new Made in America office is going to be established. I know for those who deal with the government say, oh, another office, another set of bureaucracy. But I think this is a step forward because they are, for the first time, an administration is focusing on having a particular office look into the implementation and enforcement of the executive order. And that will also then lead to a Made in America director to be appointed under this executive order. And the third takeaway, I would say that in the past, for those who are well versed with the Buy America Act and other executive orders, similar executive order, they practically, when there used to be changes to the Buy America Act or to the orders, that was very limited to contractors who to whom the Buy America Act used to apply. But contractors who were able to get exemptions based upon the trade agreement or any other international obligations could get a waiver exemption from the government in terms of their products and still sell to the federal agency. This order actually talks about that there'll be a heightened security in terms of waivers to domestic preference laws. So contractors who already had the exemption, not sure how this is going to play out, if those exemptions are going to be taken away, or there's going to be a heightened security of the applications or the exemptions. But they're definitely looking at not providing blanket waivers to companies anymore in terms of not following the Buy America Act. And we have to see what that means, at least for the existing contractors who have those exemptions. Honestly, when we read this executive order, it lays the groundwork, it lays a more heightened groundwork for tightening the restrictions regarding domestic preferences. And the focus is to narrow the gap or tighten the gap or to take care of the loopholes that allowed agencies to buy foreign-made end products. Now, what that would mean is that for government contractors and US manufacturers that were subject to the Buy America Act anyways and did not have the exemption, these proposed changes can potentially have a significant impact on their existing supply chain, which they had developed in reliance upon long-standing Buy America rules that were being followed. So if the restrictions are being heightened in terms of the loopholes in terms of buying foreign-made products and then putting those products or combining those products with the US base, that may have an impact on the supply chain of the US manufacturers and all. Another thing that's not clear in this order yet is, does it only apply to purely federal agencies or can it also apply to state agencies? Now, a good example I can give is, if you look at public universities, they are considered as state agencies. So because they also get federal guarantees. They also sometimes consider federal contracts. So would this apply to state agencies beyond federal agencies? So like I said, the executive order just came in yesterday. There's still a lot to digest and dig into, but for US manufacturers and government contractors, I think it's worth looking at it and seeing if this in any way is not aligning with their global supply chain or the existing supply chain they have, and if any tweaks need to be made in terms of manufacturing and selling products to the government. Next slide, please. Since I took up a lot of time to talk about the new executive order, we're not going to go through all my slides in the interest of times. But when we look at what happened in 2019 and 2020 from a global trade perspective, if I have to summarize, there were 4 key things that the US government focused on in terms of global trade. One was tariffs, tariffs, tariffs. 2020 has been the year of tariff in the USA. Either USA kept in place or the administration kept in place or levied a variety of tariffs and trade restrictions. So when we talk from a legal term about tariffs, we talk about Section 301. And then the Section 301 tariffs currently even, and I don't think that is going to change under the Biden administration, are at about 25% to 15%. Most of them are on Chinese origin goods, which are valued at about $500 billion. But we also saw some consequential tariffs that were applied on numerous trade relationships, such as the EU, products coming from India, from Mexico. So it was all across the board. We saw that happening. The second thing we saw was a lot of anti-dumping and countervailing duties. So there was obviously an uptick in enforcement action concerning goods, which was subject to additional, as we call AVD and CVD duties. And these were also on a wide variety of products we saw from Canada, China, India, Japan, Korea, even Vietnam. In 2021, I think Chad was pointing out to where the growth is going to be, in which sector. That could also significantly increase the AVD and the CVD cases for this multitude of products. We don't see in any time either the tariffs or the anti-dumping or countervailing duties being disbanded or, by this administration being not enforced. The third thing we saw, and I think there was a question on intellectual property, especially as it relates to China, was what we call Section 337 litigation. What in layman terms was Section 337 litigation is it's unlawful to import or sell in the US any article that infringes a valid enforceable United States intellectual property, or it creates unfair competition or methods of competition. So we saw a lot of Section 337 litigation. We saw it in the connection with the export control sanctions and limitations. One of the best examples I can share with you all on the Section 337 litigation and export control is when the US Department of Commerce added Chinese telecom giant UI Technologies and a subsidiary to this list, which it's kind of like a designation as to boycotted companies. And this designation actually prohibits anyone from anywhere in the world from exporting or exporting goods, technology, software, which are subject to export control to these companies. So there was a lot of that heightened Section 337 litigation. That's just one example. We also saw that with the government of Venezuela, and that definitely continued. I think US is going to continue to have a strategic approach of protecting its US companies' intellectual property so that there's not unfair competition with the Chinese companies, at least. That is definitely going to continue in 2021. So it'll be really important for US manufacturers or companies who are exporting to make sure that you know what are the intellectual property that are part of your products that you would want to then protect, not only in the US, but also in the foreign countries. And the last thing that I want to share that happened in terms of a big change in terms for manufacturers or suppliers is in January 2020, the government came up with, it's not the government, it's actually the World Trade Organization, came up with new Incoterms. It's called Incoterms 2020. and that went into effect. And the impact of that is any US companies who have long-term purchase agreements or long terms of sale or supply need to make sure that their agreements are in accordance with these new Incoterms so that they have protection against risk of loss. And we saw a lot due to the pandemic, plus the new Incoterms, there was definitely a lot of confusion in terms of how do you protect your risk of loss, in light of the new Incoterms that the industry had to follow. So that was another big change, and that will continue. So for those who have not revisited their supply arrangements or their supply agreements or their terms of sale may want to do that in light of the new Incoterms. And then finally, next slide, we saw that there was a lot of emphasis. Somebody had a question on trade policy. A lot of emphasis, increased attention, at least by the prior administration, and I think Chad was alluding to this too. There was a lot of focus on a number of bilateral and multilateral trade. The only one that was able to get through the Senate and the House was obviously, as we know, the new NAFTA, which is the USMCA. But there are bilateral agreements that were negotiated and are continuing to be negotiated with Japan and UK, two of the largest jurisdictions to which US exports to. So as you saw from the chart that Chad was sharing, that US does export to China quite a bit and to Japan. So it's very important for this current administration to continue to have those negotiations on the trade agreement with Japan and UK at least. And I think it becomes even more important because, as Chad mentioned, US lost out on the opportunity of not signing the TPP, which has been signed by 26 other countries, with China taking a lead on it. And then most recently, just in the last month or so, there has been a regional economic partnership agreement between 15 Asian countries, which again, US is not a part of, with Japan is a part of, China is a part of, India is a part of, so there are many Asian countries. So for manufacturing that is focused on Asia or are using Asia as a base to focus on other countries, it is going to be imperative that US has trade agreements in place, have better trade policies in place, because then that's going to lead to growth in the US manufacturing. Directly or indirectly, these trade policies do impact the bottom line in terms of growth for US manufacturing. Quickly, just few takeaways. Key takeaways I want to share with you all is, if we can get to the slide on the key takeaways, please. I would, no, it's actually the next slide on key takeaways after this. So what some of the key takeaways has been that, like I mentioned, as we have seen in the by this executive order that has come in, just one more slide, please. By the Buy America executive order that has come in, that companies which are importing goods or sourcing goods from over the world should consider to review their country of origin destination analysis for their products. Because especially if those products are going to be sold to the US government or state agencies or federal agencies. So that's going to be an important focus for 2021. The other important focus which we actually saw in 2022, increasingly a number of our clients who are in manufacturing and sourcing, they also, because of the supply chain gridlock that was created because of the pandemic, mostly focused on China, they also looked at and started contemplating sourcing from other third country suppliers. We saw a lot of uptick in terms of the supply chain shifting from China to India. I know we have Suchitra who's going to talk about India after me, but we did see that the model of finding alternative supply chains became very important, and we think that's going to continue to be the trend in 2021. Even though China has bounced back quite a bit with about 4% growth after the pandemic, but I think increasingly companies have realized, at least most of our clients have realized who are into manufacturing and global sourcing, they got to have alternative supply chain in about the same cost as the cost that's offered from China. And the countries that have been looked into is India, Vietnam, Philippines, Indonesia. So there's a lot of that continuing to happen. So that's important to consider. The third point that I want to make on the key takeaway is that companies that operate in what we call emerging technologies, if their products have what is considered emerging technology, which is considered to be important for the national security of this country, they should monitor what the US Department of Commerce rules are very carefully and prepare to comply with it if there are any new export, import prohibitions or licensing requirements that the authorities may impose upon their products. There have been a lot of changes in 2020 in laws like CIFIS and the export control laws, the trade sanctions, which makes it even more important for manufacturers who are focusing on products that have emerging technologies or technologies that are considered important to the national security interests of the country to see if there are any limitations or restrictions when it comes to export of their products or import of products to assemble with their existing technology. And then as a final key takeaway, I get this question quite a bit, and I think it's too early to talk about it, is what is the new normal for international trade? As we can see that from the prior administration to this year, there has been a question about globalization. It used to be the norm for international trade. But there's a lot of conversation that was happening last year was, will the COVID or the pandemic create a reverse gear on globalization? So we are already seeing, where the governments such as India, China, and other places who are coming up with this same version of the Buy America Act. So there's a lot of focus on manufacturing locally in their countries, and there's a lot of focus on being protective by imposing tariffs on products that come from other countries. So there has been a little bit of a reverse gear in globalization, and we don't know if that's going to continue or not. I suspect it will, which then leads to that the companies here would have to continue to pivot from time to time, depending upon how these policies start getting formulated, and then they have an impact. Like, we have seen a lot of change in pricing. Pricing of the raw material, pricing of insurance, pricing of shipping, everything has had this impact, which is also then leading to the question, does it make sense start having a manufacturing base closer to home rather than getting it from China or India? So that question that will there be a reverse gear on globalization is going to be an ongoing question, at least in the first quarter of this 2021. And then this has also led to exceptional times and exceptional actions, I would say. We have had clients who had to think of different models, and a lot of these different models, that is in terms of how do you distribute your product, how would you supply your product, how would you market your product, because gone are the days that you could go to a trade show and put your product in a big place and have everybody come and take a look at it. So there has to be a change in terms of the actions that are taken for the sale of those products. And like I said, I will end it by saying a lot is going to depend upon growth for manufacturing in the US and all over the place, depending upon the trade agreements that we are able to put in place. The new US CMA, the old NAFTA, new NAFTA is a good step forward, but we need more of those new NAFTAs for growth in US manufacturing. But with that, I'll end it, and I'll take some questions in the end. Thank you, Kimberly.
Thank you, Vanita. Very interesting. Our next presenter is Jason Maria Rathenam. As I said, Jason is a senior consultant at HLB Van Dahl in the Netherlands. He is also a board member of Cornerstone Equity Group. He received his Bachelor in Business Administration from the University of Amsterdam and a certificate from the Institute of Chartered Accountants. Jason speaks 5 languages, and English is not listed first. So it's been my pleasure to work with Jason the past probably, 8 years? How long have you been? Yeah, since 2013, I've been working with Jason. So Jason specializes in logistics, which makes sense because the Netherlands is really the big port into Europe. So we look forward to hearing from Jason and what he's seen happening in the logistics area.
Thanks, Kimberly. Last time we did this, it was back in New York City. It's about a year ago, isn't it? It was, I'm glad that we can do this online again. It's nice.
Yeah, it was October of 2019 when our global summit was live, and it was in New York City.
That's right. So I've put on my phone a timer so I don't run out of time. Good evening from the Netherlands. Yes, we're famous for logistics, but we're also famous for potatoes and tulips as well. I didn't prepare a presentation, so I just thought about, I'm going to walk you through 3 of the trends that we see in the logistics industry, particularly for manufacturing here in the Netherlands, and it could be also shared with Europe as well, and Western Europe. B2C tends to dictate how businesses are run nowadays. The consumer is slowly making their way into how businesses should run their logistics, and with companies like Amazon saying one-click button, and tomorrow or the same day you get your products at your home or at your office. We see that trend also happening in the B2B area. We see buyers getting very anxious, and they would like, they come to work thinking, well, you know, if Amazon, Alibaba, they can do it, why can't our suppliers do it as well? Why can't they deliver the next day? So that is hot in our industry. We see that as at least the clients that we serve say that's a big challenge, and speed is a big focus for our businesses to compete in the European economy and also the global economy. So as I said, delivery on time, that's huge. What we see logistics businesses doing is traditionally they would like to be, let's just say, transport light. They don't want to invest in trucks. But because of the demand that DHL, UPS, FedEx is having, we see 3PLs also getting back into buying trucks. Surprisingly, also, we've seen some trends in buying electric trucks as well to be able to control their own destiny for their clients. So time, that's big. Transparency in where products are throughout the supply chain, whether it's still in the manufacturer in China, India, wherever. We see a big trend where clients would like to see, similar to an experience that you might have had when you buy something online, that you have a tracking code and you can see exactly where your products are. The business world is operating in a similar way now, that they can pinpoint exactly where products are, because everything is timed so well and so efficient, and because even one small delay could really impact the whole supply chain and business flow. Because of that, IT costs are rising significantly. So if you're I would put some cash away in the months to come for your IT. That is probably going to be one of the biggest costs that you would like to monitor for 2021, 2022. So we got first on time, transparency on delivery, and the last one is for 3PL, 4PL versus doing it on your own. So in the past, businesses seem to have liked to, you know, if we're coming into a new zone, we'd like to do it on our own. So they go on and rent a warehouse and hire their own staff and pretty much run the operation that they used to back home. And they think, well, I'll just copy paste it in the new country that I'm in. There is a significant shift that we are seeing towards the move towards 3PL, 4PL, mainly because they can offer better rates. Because of economies of scale, because they buy shipments in big quantities, they're able to, you know, some of the practical things like you don't need to deal with staff that's not coming to work. That's all the problem with the 3PL. So that's something to consider if you're either advising clients or you are a business that is trying to come into the EU, to seriously look at what 3PLs have to offer, because then you can really just focus on your core business instead of getting into the nitty-gritty of logistics. I must say that logistics cost is rising significantly, so that's something else that you would like to should pay attention to. Logistics, it is very difficult to secure your space in sea containers and also air freight. I recently looked at a graph of how air freight costs was just as a sharp after I believe December last year, the last graph I saw, there was a huge rise in air freight costs. So you want to be being a bit smarter in how you plan that. Look at alternatives to air freight and sea freight. If products are coming from the east, you might want to look at the Silk Road. There's also trains, and they offer very competitive pricing. So talk with your advisors to see how you could manage your logistics cost. Another tip to look at when you're getting into working with a 3PL or 4PL, ask yourself this question: are you going to be a top 5 customer for the company, or are you going to be the down 100 customer for their company? You should definitely try to figure that out before engaging a 3PL, because that also will tell you how flexible they are to accustom themselves to your business. So that's the trends we see in logistics. And the second thing I would like to talk about is the challenges of doing business in the EU. It's fun. It's one of the largest economies in the world because we gather many countries together, almost 30 odd countries working together. Unfortunately, the UK is no longer part of it, but it's still a very large economy, so there's a lot of interesting reasons to be established in the EU. But things that you really need to pay attention to is government. For instance, if you've got staff that is running around the EU, you want to make sure that you don't create a nexus for yourself where you'd be liable to corporate income tax. You'd also want to pay attention to if you're selling to private individuals, keep an eye that you do VAT registrations. If you pass a certain threshold, you do not want the tax authorities on your back. Penalties can be very steep. The third point for government is GDPR, and I know there are some experts here who can talk to you a lot about GDPR. 2 things to know about GDPR. First question number 1 is, if do you have a policy if there is data leakage, and whether you are able to submit or inform authorities that there is a data leakage. I believe you have 48 hours, and if that passes and you don't do it, beware of hefty fines. Also consider getting insurances for that. And the last one, also for GDPR, is knowing where your customer information is kept. If you're in the business of dealing with direct B2C, direct to consumer, and you gather information about them, please make sure that if you're at least gathering information of EU citizens, that you would want to make sure that the information is stored in the EU and not outside. That might land you in trouble as well. So do check. The burden of the proof is on the seller. So there we go. Government. Second point was selling platforms, and this comes back again to logistics. Companies like Amazon is demanding that if you're going to trade into the EU, that you must have an EU distribution center and sometimes also an EU legal entity. Why? Because they have promise their customers a certain delivery time, and you'll probably need to sign for it, and if you cannot deliver on time, there are penalties that Amazon might impose on you, and that also might result in them kicking you off the website. So that's something that you should pay attention to. Read the fine print on when you do business with one of the large internet sellers or providers. Beware that if you have in the past used the UK as your distribution centers, things have changed significantly. What we have seen in the past is, especially for US firms, that they generally tend to come to the UK first because of English, and it's easy to, just because of the cultural link. But when Brexit came along, that changed it because there's no longer free movement of goods. To give you an example, in the past, when products were moving from the UK to the EU, it was free movement, not so much paperwork, maybe this much. Now we see in the ports that truck drivers are carrying this amount of paperwork just to cross the border. So real red tape there. So you might want to consider having two logistics warehouses, one for the UK and one for mainland Europe. The reason why you still would like to keep the UK is because it's still a very big market. So you'd like to separate them, at least two warehouses in two different jurisdictions. Also, you're going to take a look at how import taxes will work, excise taxes, because pay attention to HS codes. If you're shipping products, read the fine print or get your forwarder to advise you on that, because it can be very different from what happened from December 31st to the 1st of January. Lastly, staffing. Before I'll head back to Kimberly, staffing is a challenge right now amidst of what's happening with COVID. It is becoming very difficult to move around in the Netherlands. We have, unfortunately, in the evenings a curfew, and it might be difficult for you to get your warehouse staff to fulfill orders for you in the late evenings. Mainly because of what has been said by our government that you're not allowed to, for instance, in the Netherlands, we cannot move outside of our homes after 9:30. So pay attention, and movement restrictions might be challenging, especially if you're having a special quarter and you'd like to make sure that you can deliver products on time. Consult with your 3PL or with your staff on what you can do to make sure that you'll still be able to fulfill those orders. Last one is better employment packages. That's something that's becoming more and more of a challenge. We see that in the logistics industry, that it's hard to retain or acquire talent because employees are not stepping over to new employers that easily. So it might be a huge challenge to get staff in this season. So then again, it builds the case on maybe it's wise to look at a 3PL instead of doing it on your own. That's it for me, 1 and 2.
Thank you, Jason. 3PL, 4PL, it's all very interesting, and it's something we often talk to our clients about as they head to export, how you do it. So we're going to come back to you in the Q&A section. I already have some questions lined up for you that are coming in. Thank you, Jason. Our next panelist is Suchita Sonalika. Suchita is the Director and Head of North America for the Confederation of Indian Industry. She is responsible for managing initiatives that promote India-US and India-Canada economic relations. She's a graduate of the Robert H. Smith School of Business at the University of Maryland, College Park, and she has a master's degree in public policy from the School of Public Policy at the University of Maryland. Welcome, Suchita. We look forward to hearing from you.
Thank you, Kimberly. Can you hear me okay?
Perfectly.
Great. Thank you and the Withum team for organizing the Global Summit and for having me on this panel. I've learned a lot already from the panelists before me. We heard about economics, we heard about logistics, we heard about the regulations and the legal aspect of manufacturing. I think my remarks are a little bit more country focused. Confederation of Indian Industry. So let me start by sharing a little bit about how India's economy, India's manufacturing sector specifically is doing overall. And it would be impossible to talk about this sector without the context of the COVID-19 pandemic. And then I'll talk a little bit about how India, including the government as well as business and industry, has shown resilience and tried to minimize the impact of COVID on manufacturing as well as global trade. So the COVID-19 pandemic really damaged economic growth for the country, bringing manufacturing to a temporary halt, especially in the initial days, with significant disruptions to supply chains, increased uncertainty in the supply of raw materials, and volatility in customer demand. Both what Vinita and Jason both referenced this earlier in their remarks. During the initial lockdown period, overall India has had some 10.7 million cases of COVID. So early on, India took very, very decisive action on the lockdown, and there was a nationwide lockdown from March till about May. And during this time, manufacturing really came hurtling down. More than 70% of businesses dealt with reduced cash flows, industrial production dropped significantly, employment situation really worsened due to increasing layoffs, and international goods trade was also devastated quite a bit. But in the midst of all this, our companies showed resilience. They reorganized, they restructured, did some aggressive cost-cutting measures, etc., in the face of the adversity, and are now leading economic recovery for the country. So we really ended 2020 on a stronger note as manufacturers started to boost production again to meet rising demand. And in fact, manufacturing has now become one of the key drivers driving this economic recovery after the pandemic-induced slump. So our business activities are slowly improving. The latest results for Indian manufacturing sector point to an economy on the mend, and we are seeing supportive demand environment as well as industry's efforts to rebuild and reinforce a rise in production. Our tax collections are at record highs. Our power demand has been strong. Auto and vehicle sales, which has been a key indicator for India's manufacturing sector, was really given a big boost, especially during the festival season of Diwali, Christmas, New Year, etc., which is sort of more cultural, I suppose, to buy new vehicles around this kind of festival times. But that really showed up in the numbers, and labor participation rate also then eased off a little bit. We got some new export orders were rising at the slowest pace than we've seen because of the recent surge in coronavirus cases globally, and which really reduced our overseas demand. But the good thing about India is its really large customer base, even domestically. So we saw domestic orders growing a little bit towards the tail end of the year from maybe September onwards. And we saw gross value added in manufacturing, which was to the tune of Indian rupees 5.79 trillion, which really aligned with the corresponding periods of financial years 2019 and 2018. So very similar to the past 2 years growth that we saw. Vanita was mentioning the tariffs and the impact of the tariffs, and this is even pre-pandemic. So when the US imposed tariffs on China, we really started looking. In fact, we did a whole study on specific product lines in which the tariffs had been imposed on China, and increasingly we started getting requests and interest from US investors and US businesses who started looking to diversify their supply chains, and this was only exacerbated by the pandemic. So more and more we saw interest from US companies, European companies to fulfill supply chain orders from diverse sources. So we facilitated a number of those connections from Indian companies who really stepped up and tried to fill in the sort of global gaps. But all of this to say that not everything is not back to normal, obviously, and it may even be too early to say that this is the point of turnaround. The process of normalization really remains quite uneven as of now and very incomplete. We may have seen a temporary boost, but the momentum could be flattening for industry, investment, and external sectors, because even now we are seeing levels that are sort of 10% below the pre-pandemic normal levels. So, which brings me to, what we have tried to do, as what Indian government has done and what Indian businesses have done to minimize this impact of COVID on manufacturing and our global trade. And as challenging as the circumstances have been, it's really presented a new opportunity for India to rethink its national industrial strategy, particularly the policies concerning the economic recovery of the country. So, for example, when Prime Minister launched the Make in India initiative 4 years ago, we started looking at this sort of early on, encouraging domestic manufacturing boost. And now with this situation, the initiatives has taken a fresh has been given sort of fresh wind and wings. So the government really aims to increase the share of our manufacturing sector to country's GDP up to 25% by 2025. At the time when the initiative was launched, the current share was about 16%. So a lot of investment, a lot of policy thinking is going into driving this Make in India initiative. Very recently, in May 2020, a key reform was announced by the Indian government, which was to up FDI in defense, in the defense sector, manufacturing under the automatic route from 49% to 74%. And this is particularly important in the India-US context, because US-India defense cooperation has been really taking on quite strong, and especially our cooperation in defense innovation and technology leads us to really take advantage of this opportunity. The government also introduced a COVID stimulus package, which was about USD 266 billion. This support package included both fiscal and monetary measures. That was also announced in May 2020. And over the medium term, generally speaking, easier financial conditions, stronger global demand, and accelerated vaccinations as we get into this, massive, the biggest vaccination drive that the world will have seen. This could really lead to an economic sort of upcycle for us in 2021. With regained trust in the market and targeted government actions, industries have now shifted away from the short-term knee-jerk aggressive cost-cutting measures, which was layoffs and salary cuts and such, but now looking at more long-term ways of cost-cutting, this will invariably sort of come onto how you consolidate a particular business, how do you restructure, how do you cut down on, say, marketing expenses, and switching over to low-cost raw material sources, which will again feed into the supply chains and how we restructure our supply chains. So industry is now also working in conjunction with the government's recent focus on Atmanirbhar Bharat, which is an initiative again aimed at building a self-reliant India, and the idea is to really strengthen and embrace domestic supply systems. An overwhelming majority of businesses actually believe in this and focus on import substitution of essential commodities by pushing domestic production. And we may be at a cusp of this kind of cyclical recovery that will gain traction throughout the year, and on a strategic level, even when it comes to building our international partnerships. So we've seen the US leading and propagating this idea of a free and fair Indo-Pacific, prosperous Indo-Pacific. So countries like India, Japan, Australia, and the US have come together and decided to work together to promote more resilient supply chains in the Indo-Pacific region and across the world. I mentioned, India beginning its sort of nationwide vaccine rollout. We just started the plan earlier this month. the economy is also about to get a booster shot in the arm with the upcoming budget that will be presented by our finance minister, Nirmala Sitharaman, in a couple of days on the 1st of February. And we certainly anticipate a strong focus on the manufacturing sector, given all of their previous commitments to Make in India and Atmanirbhar Bharat and initiatives like that. So I think overall, we're starting the year on a fairly optimistic note. Our new COVID infections are now dipping sharply, so that's great to see the data, the graphs kind of going down now. And this nationwide vaccine rollout plan put in place, which we really hope will boost consumer confidence and demand to grow further. The great news is that with the latest IMF announcement, they projected economic growth in India coming in at about 11.5% in 2021, which will really enable India to reclaim its place as the world's fastest growing economy. And hopefully 2021 will be this year of transformative measures that have been set into motion across industry through resilient strengthening efforts and aspects like digital transformation and securing manufacturing and supply chains. And I hope this trend will continue. So let me stop there for the initial remarks, and I look forward to the interaction.
Great, thank you. Jim, do you want to introduce Jason?
Yes, thank you, Shachita and Kimberly. I'd like to introduce, it's my honor and pleasure to introduce Jason Thomas. He joined our Withum team in 2020, and he brings a lot of manufacturing expertise to our firm and certainly provides a look at supply chains through a different lens, drawn largely from his experience as the CFO of U.S. operations of Zhongli Corporation. So, Jason, I'll turn it over to you.
Yeah, thank you, Jim. I appreciate it. A lot of information. And the audience should know I'm trying to look at this from a CFO lens. Just started with them recently, but continue to help find my replacement as CFO and talk to the executive leadership team even as early as this morning. Just quick background, it's a $500 million company with annually with operations both in a variety of countries as well as multiple states. What I want to comment on, and I'll go relatively quick to keep us on time, is I think we received a lot of helpful information. And what I think ultimately is important is applying the information to create cost savings or profit improvements to your companies. So what I want to get to do is kind of run through a list of what's worked for Zhongli, where I was a CFO, again, looking from the CFO perspective, and hopefully some apply to these companies that you guys are each listening to, and perhaps some don't, but maybe they're good takeaways. So again, I'll go relatively quick, but to the extent you have questions or want to follow up, don't hesitate to reach out. Again, this doesn't deal with manufacturing specific, but one thing that was very significant that we did is we reduced healthcare costs by about 25%. The rationale was we're trying to improve healthcare, but the costs keep going up at an extraordinary rate while margins continue to be pinched. So we moved to a partially self-insured plan rather than an out-of-the-box type plan. And what employees are actually seeing is while it's a 25% reduction from a company perspective, there's a decreased cost on their contribution while also having an improved benefit from a healthcare perspective, especially during COVID. The last thing you want to do is send a message that we're trying to cut costs, but it's been quite the opposite. So people have been very happy, and it's evident based on the response that we have had. Another thing is having a strategic plan given the ever-changing global environment. We actually created a strategic plan a couple years back and then had to adjust accordingly, obviously given the COVID situation, the tariffs that took place as it relates to China and other countries as well. And then also we obviously have the recent new leadership with the shift of president. But that actually led us into setting parameters for practice management and knowing that we had to adjust there as well. From an automotive perspective, we started dealing with USMCA. Several of the panelists and keynote speaker commented on the executive order. So I don't think that's going to change anytime soon. So then it's a matter of locating where your manufacturing should be and taking a close look at that, whether it's in a different country. So for example, for Malaysia, our Chinese operations, we actually looked at moving to Malaysia. We support some rubber parts from an automotive perspective. as well as non-automotive. We do some rubber components, and that's actually in a different state. So we do manufacturing in the US, but also manufacturing in China. So it's a combination of both. So then you're mirroring different laws with different countries, along with different laws in different states as it relates to COVID, tariffs, etc. But having a strategic plan and holding people accountable to that, but also leveraging the flexibility, I think is relatively important. And the communication on a more continuous basis as we are either working from home or working from the office, obviously trying to be in a safe environment. The next thing I wanted to comment on, I mentioned practice management and having metrics, but we had mentioned about the increase in technology costs. I know even at Withum, we've tried to provide employees, and I'm learning that in the last couple of months, but we did the same thing at Zhongli and increasing the speed and making sure people are safe. And then you balance between that, as well as an organization that I've been involved with, as to how to keep people safe. And so you have a dichotomy of employees that some are essential that you have to be there, and then some can work from home. And then you have I'll say the mental aspect of, hey, is that fair or not fair, and how do you get through that? So talking through that from a leadership perspective, I think can be important, even from a cultural perspective. Another item I wanted to comment on is foreign currency hedging. I know with the US dollar weakening, I'd say in the last 6 months, as demonstrated by Chad's slide, even with China, separate from the tariffs, you have the Chinese RMB decreasing by about 7% just in the last 6 months or so. So as long as you have steady payments, I'd say talk to your bank about potentially discussing about opportunities, because you're not in the business of foreign currency fluctuation. You're in the business of manufacturing and making your product. And this also kind of ties into the metrics from a sales perspective. Keep an eye on how you're quoting products, because what the tax rates are right now in the US compared to what they may be in the future obviously have an impact on profitability. So those are a few things I actually want to comment on. Let me take a look here. From a supply chain standpoint, a lot of things changed over the past couple of years. Certainly with the Chinese parent company, there's concern from a cultural perspective, but also from a, hey, what's going to happen? Do the employees in the US now not like people in China? We started getting questions from our customers as it relates to when are you guys going to be able to ship? And it quickly changed to them not shipping at all to within the US. So the dynamic was very interesting. Within a 2-week period, we went from trying to demonstrate that we had the capabilities from a manufacturing perspective to distribute quickly to the fact that they started slowing down production because we weren't on their hot list. But I think Chad alluded to it, that the electronic components, and ironically, I know a few in my family that are directors of purchasing, and so a couple of them, both of them were actually on the hot list of getting product to the OEMs rather quickly because they were falling behind. So it's 1:22. We have about 8 minutes for questions. Perhaps what I do is stop there to provide some time. I'm certainly willing and able to, Jim, if you think it's needed, I can certainly summarize this list and put it out there for people to have access to. I know I ran through it quickly, but I'm trying to be conscious of people's time. So with that, I'll end it there and turn it over to Kimberly.
Thank you, Jason. Yeah, if you want to summarize that, we can get that out to all of the delegates.
Are we talking about a roadshow? Roadshow? Travel restricted, of course.
Yeah.
Yeah.
If I could ask the panelists to come back online, we do have some questions for you. And I'd like to start with Vinita. Vinita, I noticed in your slides that trade and the US went in opposite directions. And I found that just an interesting visual. So, in light of the pandemic and as companies look to sell by different modes, what are some of the legal ramifications for the different modes of selling that manufacturers should focus on?
Yeah, so there are many legal ramifications, but since we have limited time, I would say the most important one is having, and I think Jason mentioned this, having a good understanding of tax implication in terms of when you're selling. So when you're selling products to foreign countries, you don't even want to only think about VAT or what they call service tax. In India, it's called GST, the goods and service tax. But you also want to start thinking about direct taxes, which is income tax, because a lot of times companies don't realize that if they are selling through their distributors or agents, and then if by default, if they are considered to be what they call in tax definition, your dependent agent, in addition to what we call indirect taxes like VAT, service tax, GST, in whichever country you are selling in, you could also have a direct tax liability, which will be on your income that's attributable to it. So and in this pandemic, what we realize is, including in the US government, there's so much, and this is happening at state levels too, there's just so much focus on collecting revenue in terms of being able to manage the expenses this pandemic has put on the government. There's an increased heightened enforceability on recovery of taxes also. So we are advising most of our clients who are importing, exporting, that you don't have to worry only about custom duties or VAT or GST, but also start thinking about how are you structuring your sales, and does that by default trigger some income tax issues in the foreign country for you. So that's one of the most important thing I would say. The other thing is also getting a little savvy about selling through e-commerce, because the new nature of business is going to be not brick and mortar, no trade shows, maybe that will all come back, but it's all about e-commerce. Now with e-commerce, one of the risks that comes up is, I think Jason mentioned this about EU, there's the Gdpr, but in most of the countries all over the world, they do have, I had a slide on this on global privacy obligation, but we skipped it, but there are global privacy obligation. China, India, everybody has their own data protection laws. So if you as a manufacturer or as a supplier or as selling goods are going to start collecting information of your customers, which are considered to be personal information or sensitive personal information, you want to start preparing for whatever the compliance is in terms of data protection, especially if you get to e-commerce selling of products,
Right. Yeah, I know GDPR is a big issue when you sell into Europe as well. And Jason, Jason Murray Rathnam, you spoke about the increase in shipping costs and how high it's getting to ship via air or via sea. Are there any other strategies to reduce the increase or to manage the increase in the shipping costs? And what are you seeing with your logistics providers?
Don't ship.
Oh, the salespeople will love that, Jason.
Nah, it's a bit about being able to use your data and predict in the future. Don't be too action reaction kind of way of planning. Think way in advance, and there's models that you could look at that you can go as far as 1 year, 1.5 years even. So keep an eye on the trend lines. Look, it's just going to be really expensive to move product this year. So you might be looking at alternative ways, maybe finding, it depends on what exactly that you're selling, but look for suppliers that are on this continent that's with product already here. You don't necessarily need to always bring stuff from the US, but this year, logistics cost is going to be really expensive. So keep an eye.
If I can comment real quick, Kimberly.
Sure, Jason.
I just talked to the executive team at Zhongli this morning, and they were looking at double digits since December, the beginning of, and now they're almost to triple. So something to keep an eye out for and try to strategize appropriately. And as I find out more information, I'd be happy to share with the group too.
Thanks. So TJ, you talked a lot about India's COVID response, and I was thinking, here we have this pandemic, a worldwide virus, at a time when a lot of countries are becoming isolationist. They're looking inward rather than looking outward, but the virus is just going wild. So how a lot of developed countries are going to rely on Indian manufacturing for PPE, for not just the vaccine, but the goods around the vaccine. So how is India supporting global supply chains with the vaccine rollout and development?
Yeah, absolutely. I think that's a really good point that, at a time when a lot of the countries are looking inwards, India is really doing what they're calling vaccine diplomacy. So we started the rollout of the vaccines earlier this month when the Drug Controller General of India gave authorization, emergency use authorization to two vaccines, the Covishield manufactured by Pune-based Serum Institute developed in collaboration with AstraZeneca and the Oxford University, and the other one, which is Covaxin, which is developed by Hyderabad-based Bharat Biotech. And less than a week after launching the largest vaccination drive of 1.3 billion people within the country, India has shipped tens of thousands of free doses to neighboring countries, right? And as part of the partnerships and collaborations for the vaccine, even organizations like the Serum Institute have said that we'll keep 50% of whatever quantity of vaccines we produce for India, and the remaining will go to middle income and low income countries. And the pharmacy of the world will deliver to overcome the COVID challenge. This is what our foreign minister has said. And the first consignment already off to Bhutan, and then supplies were shipped off to Maldives and Bangladesh and Nepal and Sri Lanka and other countries. Almost 70% of World Health Organization's vaccine procurements are from India. And the Gates Foundation, partnered with India's Serum Institute to support vaccine production for the world. Because, at this moment, like you're saying, it's not just the vaccine, but also all of the parts and the equipment that will be needed to strengthen the resilience of developing nations' supply chains, which is necessary now to contain the pandemic globally. So we've got many other companies, Indian companies that are working in partnership with, US and British, UK-based companies to really fill and finish, even provide the manufacturing facilities and work in collaboration to bring forth some of these products. And like you said, the world is looking to India and our large-scale manufacturing capabilities and our logistical supply capabilities, and Indian industry is certainly rising to the occasion, trying to do that.
Right. Thank you.
Thank you. We have a question for Jason Thomas, but then we'll open it up for our other panelists. What are the most relevant factors you consider when deciding whether to manufacture or source product globally? And then what country-specific factors are make or break? That's a tough one, huh?
Yeah, I'll try to generalize because we started looking at a variety of countries, just given my experience, and then given my former life, I also helped source a variety of clients at the time with this specific question. The first thing is customer approval. So when working in a variety of manufacturing, if they're Fortune 500, they sometimes don't want to deal with foreign countries because they have experience with them. So getting that customer approval, saying, hey, we're looking to try to move to here, we want to make sure that you're okay with it. Second and most obvious is CapEx and return on investment. So with tariffs being relatively new, a couple of years with the Donald Trump era, how long will they last? And so if you're moving from one country to another, what's the CapEx requirement, and whether it's IRR, internal rate of return, or return on investment, I think you get my gist when you're looking at that. And you're basically rolling dice a little bit as it relates to that, because it's really out of your control. Just like with the Biden administration right now, we're not really sure, are the tariffs going away? We don't think so at this point anytime soon, but that could change in a month from now. I would say the most key item is the labor force there and who would lead that specific operation. So for example, China, Malaysia, Malaysia, you have English speaking people, but what is the labor force and what would the cost benefit be? But having the labor force and taking into account the language and cultural barriers is significant. Usually having a local person lead the operation and then having the management from the US perspective be intricately involved and aligned is the key to success, just in general, whether you have some of these other below factors or not. And then you also have to consider the shipping costs and tax implications. So I would say those are the 5 main drivers, but having the labor force and the leadership there to be successful is probably the most important thing.
Yeah.
Anybody else want to weigh in on that?
Jim, this is Vanita. I'll add, just from a legal perspective, as a part of our analysis, we do tell our clients to also look at enforceability of your intellectual property rights. You know, as you go about finding your alternative supply chain, you know, we're not going to be down on China here on IP, but you want to make sure that if the need arises, hopefully it shouldn't, but if the need arises, what are the chances of enforceability with respect to your intellectual property? Now, if you're only sourcing widgets, or if you're only providing design for widgets and nuts and bolts, that doesn't matter. But where you're talking about high-end technology products that you are looking at global manufacturing, you do want to pay a little attention to intellectual property rights in that country.
Indeed.
Right.
Jason,
Yeah, for me, it's speed, quality, price in that order.
all right, Jason, while you're on a roll, there's a question about how any innovations in the last mile of getting product to consumers.
That's a good one. Innovation last mile. The switch to electric delivery is big because that reduces the cost of, your fuel cost drops significantly if you use a different medium to transport product. Logistics planning. How much can you put into a truck, and how do you rack it so that you create the maximum amount of space for you to load up and deliver? Those are the two ones.
Capacity. All right.
Great.
Kimberly, do you see any other lingering coming in?
I think we're good. I think we're a few minutes past our 1:30 stop time, so we'll leave it there. Certainly, if you have any questions for us or for any of our panelists, if you get them to us, we will endeavor to get responses back to you. And yeah, Jason, we'll look forward to your little write-up that we'll send out to the participants as well. I want to say a big thank you to Chad, our keynote speaker this morning, and then also thank you to our panelists, Jason, Benita, Shripita, and Jason. Two Jasons. And thank you, Jim. You've been a wonderful collaborator to get this 9th annual global summit that's focused on manufacturing be a successful one.
Thanks, Kimberly. And not the last one, certainly.
And if you want to talk about the upcoming webinar in February that you're hosting.
Yeah, February 9th, we are hosting, along with our HLB international and national firm colleagues, an introspective look at M&A activity with respect to the manufacturing and supply chain sector. So we'll certainly broadcast that. We have all your emails to get that out in front of people. And, you know, in honor of the guests who joined us as panelists and speakers today, our firm will be funding donations to a local food bank in your area so that we can, you know, once again, reinforce Withum's dedication to the community and help those folks out. And in closing, you know, we're all in it together. All I can say is I stole a line from one of the networks. It said, be positive and test negative. So really back to you.
Thank you. Thank you very much. And have a great rest of the afternoon or evening, Jason. And we look forward to connecting with you soon. Bye-bye.
Thanks, everybody. Stay safe.